There's a quiet room in Omaha where billions of dollars sit untouched. Because of 8 ironclad rules that Warren Buffett swore he would never break, most people fail financially because of the frantic actions they take every single day. But Warren Buffett built an unmatched empire on a foundation of deliberate, absolute inaction. We live in a world that constantly screams at us to do more, trade faster, chase the newest trend, and leverage every single dollar we own. Wall Street thrives on the intoxicating illusion that constant motion equals progress, that sitting still is a sin, and that missing out on the latest speculative craze is a financial disaster waiting to happen. Enter Warren Buffett. For nearly a century, while millions chased every shiny object that crossed their screens, he sat back with a simple, radical philosophy. True financial genius isn't about what you do right. It is about the dangerous things you refuse to do, no matter how loud the crowd gets. Think about that for a moment. Imagine having the power to buy almost anything on earth, and yet possessing the extraordinary discipline to walk away from 12 specific temptations that utterly destroy everyone else. The first rule in his silent vault is something most investors find almost impossible to accept. He refuses to ever invest in businesses he does not fully understand. While others rush into complex technologies, opaque derivatives, or hyped-up industries just because everyone else is talking about them, Warren Buffett simply shakes his head and walks away. He knows that complexity is often just a mask for hidden risk, a smoke screen designed to hide a lack of underlying economic reality. If you cannot explain how a business makes its money on the back of a napkin in 2 minutes, he believes you are not investing. You are merely gambling, and that brings us to the second boundary in his fortress of discipline, the absolute rejection of borrowed money or leverage. Wall Street loves debt because it supercharges returns. Until the market sneezes, the tide goes out, and that exact same leverage mercilessly wipes out everything you own in a matter of seconds. Warren Buffett has watched brilliant, hyper-intelligent people go completely bankrupt simply because they borrowed money to chase a sure thing. He learned early on a fundamental truth that most people only discover after it is too late. Being smart is not enough to survive financial gravity if you are carrying the crushing weight of debt. He would rather grow rich slowly than risk waking up tomorrow with nothing because he borrowed money today. Which leads directly to his third strict refusal. He never, under any circumstances, lets short-term market panic dictate his long-term decisions. When the stock market drops 20, 30, or 40% and mass hysteria fills the television screens, the average investor feels a cold wave of panic and sells at the absolute worst possible moment. They let fear make their choices for them. Warren Buffett looks at that exact same market crash with calm detachment, because he has already decided that emotional reactions have no place in capital allocation. He knows that market volatility is not a verdict on a business's true value. It is simply the emotional weather report of a room full of impatient people. Instead of running for the exits, he waits. Because he has trained his mind to see chaos not as a threat but as an invitation to pick up quality assets at a discount. And that same calm discipline governs his fourth boundary. He refuses to follow the herd. When a speculative mania takes over the world, whether it is tulipbulbs.com startups or overhyped digital tokens, ordinary people feel an overwhelming psychological pressure to join in just so they don't feel left behind. It is the primitive human urge to belong disguised as an investment strategy. Warren Buffett understands this deeply human weakness, and he actively trains himself to do the exact opposite of what everyone else is doing. He famously noted that you must be fearful when others are greedy, and greedy only when others are fearful. If an investment requires you to rely on someone else being willing to pay a higher price for it tomorrow just because the hype train is moving, he wants nothing to do with it. He looks for intrinsic value, cash flow durability, and economic moats, things that generate real wealth regardless of what the person next to you is buying or selling. The fifth item on his list of absolute rejections might surprise you. He refuses to try and time the market. Countless financial analysts spend their entire lives staring at squiggly lines on charts, trying to predict whether the market will go up or down next Tuesday. Warren Buffett considers this an absolute waste of precious human energy. He knows that nobody can consistently predict short-term market movements, and anyone who claims they can is either fooling themselves or trying to fool you. Instead of trying to time the unpredictable waves, he focuses entirely on buying wonderful businesses at reasonable prices and holding them for decades. Time in the market will always beat timing the market. A simple truth that saves him from endless stress and poor decisions. Moving deeper into his protective framework brings us to the sixth rule. He refuses to partner with people of questionable character or poor integrity. You can analyze a balance sheet until your eyes hurt, you can study profit margins and return on equity, but if the management team running the company lacks honesty, the business is ultimately built on sinking sand. Warren Buffett looks for three things when evaluating leadership: intelligence, energy, and integrity. And he knows that if integrity is missing, the first two will destroy you completely. Because a brilliant, energetic crook will find creative ways to ruin a business faster than an incompetent one ever could. He would rather partner with average minds who possess absolute honesty than certified geniuses who lack a moral compass. The seventh boundary he guards with absolute vigilance is the refusal to chase quick, easy riches. Modern culture worships overnight success stories, viral fortunes made in weeks, speculative trades that turn a hobbyist into a millionaire, and the constant promise of a shortcut to the top. Warren Buffett views this entire mindset as a dangerous illusion. He compares wealth building to rolling a snowball down a very long hill. The secret isn't the size of the initial flake or even the speed of the slope. It is the length of the hill. When you chase quick money, you take stupid risks, cut corners, and abandon the steady, compounding habits that actually build generational security. He knows that anything that promises to make you rich fast is almost certainly designed to make you poor just as quickly. Expanding further into his fortress of wealth preservation, we encounter his eighth strict prohibition. He refuses to fall into the trap of overdiversification out of fear. While conventional financial advisors preach scattering your money across dozens of random stocks you know nothing about, Warren Buffett believes that true safety comes from deep, concentrated knowledge. Diversification is often a protection against ignorance. But if you truly understand a business, its economic moat, and its management, spreading your capital thin across mediocre companies only dilutes your potential and increases your exposure to risk. He prefers to place large, calculated bets on a handful of extraordinary businesses and monitor them like a hawk, rather than owning a basket of mediocrity that he cannot possibly keep track of. That brings us directly to the ninth layer of his financial philosophy. He refuses to ignore the hidden weight of high investment fees and frictional costs. Most everyday investors bleed money slowly and silently every single year through management fees, trading commissions, advisory charges, and tax inefficiencies that chip away at their returns. Warren Buffett knows that over a span of decades, high fees act like a silent tax on compounding, quietly transferring wealth from your pocket to the pockets of financial middlemen. He structures his entire investing approach to minimize frictional costs, keeping turnover low and holding assets for the long haul so that every single dollar works for him without being constantly taxed or skimmed along the way. Then there is the 10th boundary, which reveals his deep understanding of corporate governance. He refuses to invest in companies that retain earnings without generating a high return on capital. If a company makes $1 billion in profit, but management insists on reinvesting that money into low-yielding projects just to expand their empire or feed their egos, they are destroying shareholder value. Warren Buffett demands that management either reinvest retained earnings at high rates of return or distribute that cash back to the owners through dividends or share buybacks. He has zero patience for corporate executives who treat shareholder money like their own personal piggy bank to fund vanity projects that produce no real economic output. Delving even deeper into his psychological framework brings us to the 11th rule. He refuses to let ego or pride override objective reality when an investment goes wrong. When an ordinary person buys a stock or a business that starts failing, human pride steps in, convincing them to hold on, double down, and pray for a miracle just so they don't have to admit they made a mistake. Warren Buffett views this emotional stubbornness as a capital-destroying disease. He has no problem cutting ties with an investment the moment he realizes his original thesis was flawed, treating a mistake not as a blow to his ego, but as a cheap tuition fee paid to the school of experience. He cares about being right and growing his capital, not about looking infallible to the public eye. And finally, the 12th and most profound thing he would never do with his money. He refuses to sacrifice his peace of mind for the sake of an extra percentage point of return. At the end of the day, all the billions of dollars in Nebraska cannot buy back a single hour of lost sleep or repair a fractured spirit. Many people spend their entire lives accumulating wealth by stressing over every market tick, worrying about every geopolitical headline, and letting their investments consume their daily existence. Warren Buffett structured his entire life and investment philosophy to ensure that money serves his peace of mind, rather than holding it hostage. He keeps cash cushions, avoids unnecessary complexity, and stays within his circle of competence so he can sleep soundly every single night, completely unbothered by the noise of the world. When you look closely at these 12 absolute refusals, you realize something remarkable. Warren Buffett's legendary success wasn't created by doing extraordinary things that nobody else could possibly figure out. It was forged entirely through the extraordinary discipline of refusing to do the foolish things that almost everyone else gives into. The real secret to building wealth isn't a complex formula hidden in a textbook. It is the quiet, powerful realization that sometimes the most profitable thing you can possibly do with your money is absolutely nothing at all.